If you've been wondering why Pi Network still feels frozen in place while the rest of the crypto market seems to be moving ahead, you're definitely not alone. A lot of Pi holders are asking the same question, especially as we move closer to 2026 and see major shifts happening quietly behind the scenes. While price charts and social media hype grab attention, the real story in crypto right now is happening at the institutional and regulatory level, and that story explains a lot about why Pi Network is still waiting on a Binance listing. Today, I want to break this down in a realistic way. Not hype, not fear, and not blind optimism. We're going to talk about why Binance hasn't listed Pi yet, what major exchanges are actually worried about, and how much bigger trends like regulation, stablecoins, tokenization, and artificial intelligence are changing the rules for every crypto project, including Pi Network. By the end of this video, you should have a clearer picture of where Pi stands and what really matters going forward. Pi Network has attracted massive attention largely because of one thing: the expectation of a major exchange listing. For many people, Binance represents validation, liquidity, and global visibility. Back in early 2025, the Pi community showed just how strong that expectation was when more than 86% of voters supported a Binance listing. That level of community agreement is extremely rare in crypto. And yet, here we are in early 2026 with no official response from Binance. No approval, no rejection, just silence. That silence has created frustration and endless speculation. Some people believe Binance is deliberately delaying. Others think Pi is being ignored. But the reality is more complex, and to understand it, you have to look at how the crypto industry itself has changed over the past few years. Large exchanges like Binance no longer operate in the same environment they did during the last bull cycle. After Binance reached a multi-billion-dollar settlement with U.S. regulators in 2023, the entire company shifted its approach. Listings are no longer driven by hype, community size, or social media noise. They are driven by compliance, legal risk, transparency, and long-term sustainability. Exchanges today behave much more like regulated financial institutions than fast-moving tech startups. This change alone explains a lot. Every new token listing now represents potential regulatory exposure. Exchanges have to evaluate not just market demand, but also legal clarity, token distribution, technical architecture, and governance. If anything looks unclear or unfinished, hesitation becomes the safer option. Transparency is another major issue shaping this moment. Pi Network runs on its own blockchain, which gives it independence and control, but it also creates challenges. Integrating a custom blockchain into a major exchange requires more technical work than listing a token built on widely adopted networks. Beyond that, limited public access to core technical details makes it harder for independent auditors and exchange developers to fully assess security, decentralization, and long-term reliability. Across the industry, projects that are open, auditable, and easy to integrate are moving faster. Closed or partially transparent systems tend to move slower, not necessarily because they're bad projects, but because risk-averse institutions want clarity before commitment. This is one of the key reasons Pi Network is still being observed rather than embraced by major exchanges. At the same time, crypto itself is entering a much bigger transition that goes far beyond any single project. As we move toward 2026, institutional interest keeps circling around three interconnected ideas: stablecoins, tokenization, and artificial intelligence. What makes this cycle different from previous ones is that these three trends are no longer separate. They are starting to merge into a single technological and financial ecosystem. Crypto is no longer just about trading tokens. It's becoming the infrastructure that new digital systems are built on. Artificial intelligence is already deeply embedded in global finance, from high-frequency trading to risk analysis and market data processing. But traditional financial systems were built for humans, banks, and legal entities, not autonomous software. AI cannot open bank accounts, complete KYC, or move money freely across borders on its own. That limitation holds it back. Crypto changes that by offering programmable money and on-chain assets that software can directly interact with. Stablecoins are especially important here because they provide a global, always available form of money that doesn't depend on banking hours or national borders. Tokenization takes this further by allowing real-world assets like stocks, bonds, commodities, and even real estate to exist on-chain. In this environment, AI systems can analyze, manage, and trade assets automatically with speed and precision that humans simply can't match. This is one of the most important shifts happening in crypto right now, even though it doesn't always make headlines. Another powerful development is machine-to-machine payments. New micropayment systems allow AI agents to pay each other for data, computing power, storage, or services. This lays the groundwork for an autonomous digital economy where software systems interact economically without constant human input. It may sound futuristic, but it's already starting to take shape, and crypto is the technology that makes it possible. AI is also expanding beyond trading into broader crypto operations. It's beginning to manage treasuries, support decentralized organizations, and help operate tokenized real-world assets by processing massive amounts of real-time data. AI can improve liquidity management, automate compliance checks, and verify assets more efficiently, allowing markets to operate continuously instead of being limited by traditional schedules. At the individual level, AI-driven portfolio management is growing as well. Autonomous systems can rebalance portfolios automatically based on predefined strategies, and surveys suggest many investors are already comfortable letting AI manage part of their assets. But this future isn't without serious risks. AI can misread market signals, fail to detect manipulation, or act confidently on incorrect information. In crypto, small errors can turn into major losses very quickly. There are also technical risks. Many AI strategies follow predictable patterns, making them vulnerable to exploitation. Giving autonomous systems full control over private keys introduces significant security concerns, especially when interacting with complex decentralized finance platforms. These risks highlight why decentralization isn't just a philosophical idea, but a practical necessity. Most AI today relies on centralized cloud providers, which are expensive, prone to outages, and limited by data center capacity. Training advanced AI models can cost tens of millions of dollars, and those costs continue to rise. Decentralized computing networks offer an alternative by pooling computing power across distributed systems, often at lower cost. Decentralized storage and on-chain verification improve transparency, reliability, and resistance to censorship. Crypto also plays a role in data quality and privacy, allowing systems to reward high-quality data, track its origin on-chain, and protect sensitive information using advanced cryptography. Over time, these tools could make AI more accurate, more secure, and more trustworthy, especially in finance and enterprise use cases. For investors, this convergence of crypto and AI creates both opportunity and risk. Not every project will matter, and many will be driven more by hype than real utility. Regulation will play a major role in separating serious infrastructure from empty promises. So where does this leave Pi Network? Pi sits at a crossroads. The market is moving toward real infrastructure, transparency, and regulatory readiness. Until Pi clearly aligns with those expectations, major exchanges like Binance are likely to remain cautious. Community optimism is powerful, but in today's crypto environment, optimism alone isn't enough. If you found this breakdown useful, hit the like button so more people can see it. Share your thoughts in the comments. Do you think Pi Network will adapt to these new realities, or will it struggle to keep up? And don't forget to subscribe for more honest crypto updates, deep dives, and real conversations about where this market is actually heading next.